We might suddenly have a lump sum with us, an inheritance, money sitting idle, or a bonus. We could be in a bear market, flat market, or a bull market. And the question is very simple: how should I invest this lump sum? Most advice starts by saying that time in the market is more important than timing the market. While this is true, markets are a lot messier than that. Because the decision is not whether to invest it or not. The question is how to invest it. Gradually, all at once, or somewhere in between. We will answer this question using a real UTI Nifty 50 index data along with 3 market crashes against which we will test this. The 2000 dot-com burst, the 2008 financial crisis, and the 2020 COVID crisis. So this is the plan. Assume you have 1 lakh lump sum to invest, and you will have 4 options. One is a lump sum investment, and the other is you can invest the same lump sum through SIP for 1 year, same SIP for 2 years, and SIP for 3 years. We test these options across all the 3 crash scenarios. Let us begin. Scenario 1 is the COVID crash of 2020. It was brutal, but recovery was extremely fast, probably the fastest in history. Interestingly, here are the results. The 3-year SIP struggled. The 2-year SIP did slightly better, but the 1-year SIP actually bet even the lump sum investing. Why? Markets fell sharply. At the same time, they also recovered quickly. And because of that, the 1-year SIP was able to accumulate more number of units than the lump sum investment or 2-year or 3-year SIP. Because the markets recovered quickly, and by the time the 2-year or the 3-year SIP started accumulating units, the prices had already gotten up. So here is a key learning from the COVID crash scenario. When recovery is very fast, investing quickly works better. Scenario 2 is the 2008 global financial crisis, which followed a very slow recovery process. So the markets fell very sharply and then took a long time to recover. It was flat for a long period of time. Here, lump sum investment absolutely struggled. 1-year SIP helped, but okay, not still the best. 2-year SIP did the best during this period, and 3-year SIP did slightly lower than the 1-year SIP. But why? Because the prices were stagnant for a long period of time, the 2-year SIP was ideal for this particular scenario. So when recovery is very slow, slightly longer deployment or investment actually helps, and that is the key takeaway from this scenario. And scenario 3 is the interesting one, the dot-com crash of 2000. It was followed by a slow, very uneven recovery process. So 2000 to 2002, this period kind of sits between scenario 1 and scenario 2. And in this scenario, lump sum actually eventually recovered, but very slowly. 3-year SIP actually performed the best, and 2-year SIP came next, and 1-year SIP was actually the least effective of all the things. So here, when a recovery is slow and is uneven, a very longer SIP actually helps. Let's take a step back. Across all 3 scenarios, the pattern is very clear. Fast recovery, faster deployment or faster SIP periods or lower SIP periods work better. Slow recovery, you want even slightly more or slightly longer SIP periods. So what decides the outcome? The speed of market recovery. And that's the problem. We will never know this in advance. So what do? And precisely that is why this should not be a SIP versus lump sum debate. The question we should always ask is, if I have a lump sum, how fast should I invest it? From the three scenarios, one thing is clear: you cannot predict the solution or perfect the solution. So the goal should lie in actually avoiding the worst mistakes. So the goal is to avoid being very wrong. A simple framework for you, which will help you make this decision, is here. So the markets have crashed extremely hard, valuations are low. For example, Nifty 50 PE is, let's say, 20. Deploy faster. If the markets are on a gradual downtrend, then stagger your deployment for a longer period of time. And if you're someone like me who do not want complications and want automation of investment, then you just do the SIP of the lump sum over a period of 1 to 1.5 years. And that avoids being wrong most of the time. This would not give you the perfect outcome always, but it avoids most of the worst outcomes. And that matters because, as great investors say, avoiding the worst mistakes is half investing. Thoughtful investment of lump sum over a period of 1 to 1.5 years just does that.